Hello, 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 everyone. Grant Sullivan here with the Financial Enhancement Group. Thank you so much for joining us at the top of the hour at 2 o'clock Eastern Standard Time for a year-end tax planning workshop. Definitely, it's exciting and also very warming to my heart to see so many new faces coming in to discuss elements of tax planning at year end. This is obviously for many actually, not a very loved topic, taxes. But for Aaron and myself, this is definitely what keeps us up at night and really allows us to get fulfillment from our careers and helping individuals essentially play the most efficient tax game humanly possible with the IRS. As we start here, some little things to kind of cover together. We're going to address as many of the questions as we can that were submitted. Thank you for all of you that are attending for submitting a copious amount of questions. There's a lot of good stuff we can cover. In the hour we have together, I'll be transparent. We will not be able to cover everything, but we'll cover the topics that are getting the most amount of traction, meaning commonality in the questions. And so as a lot of you are being brought on board by my team, Jubilee, Tarna, and Brittany, again, welcome for those that are just joining. Super excited to have you as part of the conversation. A couple things to get through as well. If you have questions, please don't hesitate to use the controls on your screen to raise your hand. We can definitely get to those live, or feel free, please, to put any questions you have in the chat feature, as Tarna will ensure that we get those questions accordingly as we kind of go out and go through our examples. Another caveat is we understand that taxes are very personal to your situation because it involves monetary considerations, the hard work you have put into building your wealth and your standard of living and your lifestyle. And so if we feel that a conversation is better had individually, we'll definitely help facilitate connection for us to continue the conversation offline and maybe have a complimentary discussion about your situation. So that being said, I'm going to go ahead and ask the team to go ahead and go to the next slide and get our compliance work out of the way. So Financial Enhancement Group is an SEC registered investment advisor. For those of you on the screen, what that means is this. We take a look at your resources and we plan with your resources if we were in your situation and had to make the same decisions you do, right? That is the fiduciary code. It is understanding what you are dealing with, what you're up against, what you're trying to accomplish, and providing you information and strategy and tactics that allow you to live financially free and well in your particular situation. So wanted to make sure our compliance team is well aware. We went through that slide. So the two gentlemen that will be providing the bulk of the conversation is myself, but first and foremost, Aaron Rayum, our Director of Financial Planning. Aaron really is the one that oversees our team that deals with more than about $750 million of assets across multiple states, 30 plus to be exact, or to be in range. And has been here for quite a while, 9 years, and he is a certified kingdom advisor, which means he is very apt and adept at helping our families not become bigger givers, but become better givers, more efficient givers, which consequently, there's a lot of questions that we will touch on about giving at year end and helping to maximize that tax situation. And then for me, just for those of you who are who don't know who I am as well, I've been with the Financial Enhancement Group since 2016. I do have a financial planning degree from the great University of Purdue, boiler up, hammer down. I am also an accredited investment fiduciary by license and study, and I am a Hoosier native as well. So that's who Aaron and I are in a nutshell. And so really kind of diving into the discussion today, I want to make this meaningful because you're here not necessarily to hear about our organization and learn about our backgrounds, but really let's put some of these questions out there and get them answered. So going back to the heart of the topic, and that is tax planning, year end. Why do we do tax planning? What's the difference between that and tax reporting? And then we'll get into some of those questions. So Aaron, if you do me a massive favor, just tee us off and describe the difference between tax planning and tax reporting and why between now and the end of the year, these conversations, these questions that have been asked are so important.
Yeah, thank you, Grant, and thank you for opening in the introduction. Many of you on the screen work with us at FEG directly, and some of you don't. But one of the consistent messages that we teach people is a big difference between tax planning and tax reporting. Tax planning are proactive strategies that need to be enacted prior to the clock striking midnight on December 31st of this current year. Tax reporting is providing your CPA, providing your tax preparer, everything that you did in the previous year. So what you've done in 2024 will be reported by April 15th, sometimes with an extension, October 15th of 2025. So major difference, tax planning is proactive strategies to get things done that can have an effect on your tax return this year. The reporting happens the following year.
Thank you very much, Aaron, for describing that. And so with our runway being fairly short between now and the end of the year to make decisions happen, one thing I will caveat is this. Even though technically we have until December 31st, something to be mindful of is that whoever you're working with, whether it be Schwab or Fidelity, Vanguard, and you're wanting to make tax planning decisions or execute on tax planning decisions, you want to make sure that you give your custodian enough time to transact. We have unfortunately seen where some individuals and families have tried to wait to the last minute to engage in tax planning, and they get caught in that funnel of everyone trying to do it last minute. You want to try and get some of your tax planning decisions made within the next couple of weeks so they can be executed a couple of weeks before year end, so you're not left behind.
Now,
So,
Grant, as just a quick caveat to that, there
sure.
are a couple things that can happen next year, like maybe you didn't make an IRA contribution or a Roth IRA contribution. Those types of things can be done up until tax filing the following year. But things that we're talking about would be more charitable gifting conversations, 529 plan contributions, and we'll get into some of the weeds. But there's a couple things that we can do the following year, but it's very minimal.
Absolutely, Aaron. Well said. So Aaron, really, because there are so many questions, if you're okay with it, I'm going to go ahead and just dive into a lot of the great questions that have been asked of us. It sounds
Sure.
like some general tax planning concepts are already understood. And
Yeah, if
so
we
really
could
just to get
put
to
the
the meat of
first slide
this.
up on the screen.
Oh yeah, that's a good point. Team, we get that first slide up. It'll help kind of segue the discussion. Oop, there we go.
Perfect.
So, and this ties into a few questions that we received. Mitigating, which I love, was not the word evade, but mitigating tax liability through strategies outside of the 401k and the HSA. Now, originally this question was specifically for W-2 income. And just to kind of lay the foundation there for those of us that are W-2 wage earners, right? The two predominant ways that we can lower our taxable income today is by making 401k plan contributions that are tax deferred, meaning we're not recognizing that as income today, we're going to recognize it in the future. And that is a top line deduction, which removes the income. And HSAs, health savings accounts, also operate in that same way. So if we have a W-2 wage income, and we know those are two of the predominant ways we can lower our tax liability, Aaron, what are some other areas that we should consider if we're a W-2 wage earner? What are some other thoughts we can help bring to the table when it comes to helping mitigate that tax obligation?
If you have an IRA account and your income is below the threshold, Grant, you can always contribute to a traditional IRA. If you're age 50 or under, it's $7,000. If you're 50 or older, you get $1,000 a year catch up, and that is per couple if you're a married household. So you can put up to somewhere between $14,000 and $16,000 inside of IRA accounts that would also reduce some tax mitigation if that was something that your overall financial plan needed. There's other strategies that we can use, Grant, but it's probably more in line with gifting and those types of things, 529 plan contributions. Anything else you're thinking of specifically?
The big one I was going to bring up for this are those 529 plan contributions. So section 529, for those that are new to the concept, is a tax code line that allows us to use qualified education plans. And we can shelter money away for our grandchildren or children's education. And depending on the state you live in, because these 529 plans are state dependent, you could have tax deferral capability, or you could have tax credit capability on the state side. So other things for you to consider, depending on what state you live in. There's also state legislation that you want to pay attention to. So for example, in certain counties in Indiana and the state as a whole, if you're making contributions to certain universities, right, there's a small credit you can get to make those contributions, et cetera. So there's ways that you can, if you're charitably inclined, as Aaron said, to really ratchet up some savings that are credited to you. And then there's also education vehicles we can use in order to help with that situation as well. And so, Aaron, if there's nothing else you want to add to that, we can go to the next slide. That's some of the other questions that we have.
Yeah, I want to hone in just a little bit more on the reduction of income. You know, if you're QCD eligible, which age 70 and a half or older, you can, if you're having to gift to charities, you can use what's called a qualified charitable donation or distribution. And that's using what money inside of a tax deferred IRA account. So if you're charitably inclined and you're doing giving and you're over age 70 and a half, we need to look at making sure you're doing that in the most efficient way. The same thing with stock gifts. So if you were to itemize using appreciated assets, so you have highly appreciated stock. Let's take one of the stocks that have done very well this year, NVIDIA. If you purchase that at a lower price and you want to pass some of that tax burden off, you can do that if you're charitably inclined and wanting to make a large enough donation that would put you over and above the standard deduction. And so multiple ways, Grant, to continue to look at doing some of those strategies.
Absolutely. And Kale, thank you for adding your question. We'll get to that when we get to the charitable conversation and questions. And then Kevin, we'll get to yours as well once we get to the kind of the Roth IRA conversions. I want to let you know we saw those questions. Then we're going to wrap those into the conversation at that point as well. So let's get back to that slide, Jubilee, and NUA considerations, pros and cons. So this is a very specific discussion to certain individuals. So NUA, just to kind of talk about what it stands for, is net unrealized appreciation. And this is a way for larger corporations where we generally see it, provide access to stock option in a plan. And it's given in such a way that we get deferral on it for a period of time. And then once vesting schedules hit, right, then we can have capital gains exposure on the back end. So it's a very complicated tool that allows larger entities to what we call put golden handcuffs on key team members. And so if you have NUA consideration, every corporation does it just a little bit differently. But one way to see if you have NUA is if you have individual stock option inside of your 401k plan that is not held inside of the 401k plan, but adjacent to it. And it has to be inside the 401k plan or adjacent to in order for the tax rules to play out. So for that question, if whoever asked that question, I would highly advise and recommend that we schedule a time together to analyze your situation, because that nuance, that type of planning is very specific, also very exciting. So for the individual or group of individuals that have that situation, love to talk to you in a complimentary meeting setting to kind of work through that with you and make sure you're making the right decision with it. Because unfortunately, we have seen individuals who have left those career paths or those companies get hit with some serious tax considerations because they just didn't fully understand how that fit into their plan. But again, fun conversation. Not one we're going to spend a lot of time in today, but I wanted to put a pin in that for those who want to have the conversation, because there are things Aaron and I want to get to as far as gifting and Roth conversions, which should make up the bulk of the questions we have. So if someone's out there with that question, please don't hesitate to set up a complimentary meeting. Say that 5 times fast, with Aaron or myself to continue that conversation. All right. What I call oh goodness, where did we go? Oh, there, technology's back. The meat of where the majority of our conversations came from. So Roth conversions, pros and cons. And so this comes back to, Kevin, your question, and we'll dive into that. And then Murali, great question. We're going to talk about that as well in this section. And so Aaron, let's kind of go ahead and start with the top, which is, what are the pros and cons of a Roth conversion? Why would you consider it?
Mm-hmm.
What things do we have to really pay attention to, then we can get into the nuances of some of the questions that have come through?
So just to kind of make a basic statement, what a Roth conversion is when you're taking tax-deferred IRA dollars and moving those to a Roth IRA. And just to set the tone on this, is there were in the past to where you had income restrictions on being able to do Roth conversions. And so back in 2007, the IRS laid out their tax guidelines saying that starting in 2010, they were going to reduce or eliminate the restriction of how much money you could earn in order to do Roth conversions. Back then, it was $100,000 of adjusted gross income. So to do a Roth IRA conversion today, there are no income restrictions. Where people get confused is they get confused on the 2 C's of a Roth. There's contributions and conversions. You can make a contribution annually between $7,000 and $8,000 to a Roth IRA. A conversion, you can do an unlimited amount, and that's where we'll get into some of the pros and cons. So just to set that up, moving money from a tax-deferred IRA, paying the tax today so that you have future tax-free growth going forward. Some of the pros: Roth IRAs are not subject to required minimum distributions at age 73. The earnings grow tax-free. The distributions grow tax-free. So another pro to that is, again, the earnings and the taxes, or the earnings and the distributions are tax-free. The other thing to plan for, and why we look at Roth conversions as part of our planning strategy, is at some point, if you're married filing jointly, you are going to have a spouse that passes away. And the way that our marginal tax system works is there's a set of stair steps, and we'll get into this. The more dollars you make, the more your dollars are taxed. And today, married filing jointly, you can earn roughly $94,000 of taxable income. So you take your adjusted gross income minus your standard deduction or itemizations, and that gets you your taxable income. Today, you can make about $94,000 of taxable income and stay in the 12% tax bracket or below. Now, that number is cut in half when you lose a spouse. And so what a lot of people do is they defer their RMDs until their RMD age, and you have $1 million IRA accounts that are having to take 4% of that out on average and grow throughout life expectancy. You can create major tax problems in the future. So pros: they avoid RMDs, the pass to heirs tax-free. There is a 10-year rule. So your estate has to take that out, or your beneficiary has to take the money out of the Roth account within a 10-year period of time. The cons are you have to pay the tax today. You've got to pay that taxation up front. And they're not for everybody. Maybe you have a well-balanced portfolio of good tax diversified accounts and you're charitably inclined. So if you're going to use QCDs in the future, we don't have to drain or do all of the conversions out of the IRA account at one time because you can use that to gift to charities. Grant, anything else you want to add?
Very well said. I think, Aaron, as we kind of go into the nuance of the conversion, if we can, it might make sense to enter Kevin's situation into our planning software to use it as the example. One thing Aaron and I wanted to bring to the table, and thank you for the specific examples, was give you a visual illustration of what we're talking about when it comes to the stair steps and the ladders. And so when looking at Roth conversions, they're great estate planning tools. So for the question that just came in, can they be passed to the estate tax-free? Yes, they can. That's part of some of the planning techniques that we use as we transfer wealth from generation to generation. When it comes to a Roth IRA, they're very powerful tools that can help us grow resources tax-free regardless, right, of the 10-year window for at least 10 years and allow those to it allows us to continue to build that generational wealth for our heirs. So looking at, Kevin, the question you put in, because there were multiple questions that aligned to this, so it is a good example. And here's the question for those that may not be able to read the message. Can I convert a pre-tax IRA to a Roth IRA? And how may it affect IRMA? Now, IRMA is very important because what Kevin is suggesting, what we want to pay attention to, thanks, Aaron. When you did that, my question went away. I was like, oh no. Is IRMA represents the MAGI or modified adjusted gross income calculator that we have to pay attention to that affects Medicare premiums. So for those of you on this with us today that are already taking Medicare premiums, are paying Medicare premiums through Social Security or through a check, right? That premium cost is based on the amount of money you earned 2 years in the past. And so the income that you're using your Medicare premiums to pay the base on today was from income you earned in 2022. And so when they're asking how it may affect my IRMA, the question that Kevin's asking is, how does this affect the extra, I call it tax, on my Medicare premiums for that year when they are due? So even if you're not really ready to take distributions, and so remember what this means is required minimum distributions. That can has been kicked down the road quite a bit. For some of us here, we've already started our RMDs and required minimum distributions are coming out of our tax deferred accounts as we speak. For others, because of birth dates, that year is 72 or 73 or 75, right? And so maybe required minimum distributions have not kicked in, but we're still taking Medicare and paying premiums starting at age 65. So we have to be cognizant of that window, right? What can we do in that window beforehand to ensure we don't have automatic premium increases just because of our RMDs? And so they gave us an example. And so if you want to pull that up, Aaron, we can go through what you had there.
Yeah, and Grant, this is not specific to Kevin's situation, but this will get
It'll do. Yeah, it'll
general
do.
point across.
Perfect. And I'll let you run that, Aaron. So Aaron and I wanted to try and give everyone here today a visual representation of how this works and what this looks like, instead of just conceptually talking about it and having you stare at our faces. So Aaron, I'll let you kind of walk through the concept that ties into Kevin's question.
Yeah, so we do a lot of Roth conversions here at FEG. It's part of the staple as a practice that we implement, and we work in conjunction with a lot of CPA partners across the industry. And so as advisors, we're having proactive tax planning meetings with the families that we're blessed to serve. And as Grant said, a lot of our family situations are different, they're unique, and so that's why we build these customizable plans. And so what I want to show you on the screen here is just a retired couple, John and Sue Sample, age 67. Both of them decided to start their Social Security, and then they also have a little bit of pension income. One of the main things that Grant and I like to focus on before we get into this is helping our families figure out what their standard of living is. And once we understand what that standard of living is, we can help our families with the distribution strategy. So just in this case, we're going to say John and Sue have a modest standard of living, and their pension and Social Security income are covering that standard of living. As you can see on the screen, they had some interest in a savings account, earned about $4,500 this year. Their pension income's roughly $36,000 or $3,000 a month. Got some Social Security income of $55,000. How Social Security works is up to 85% of that value can be taxed. So in this scenario, about half of their Social Security is being subject to taxation. So as we scroll down through here, we've got a total income of roughly $69,900. And looking at their standard deduction, they can take off $32,300. So their taxable income is roughly $34,600. Well, under that current situation, their total tax due is roughly $3,688, and it puts their effective tax rate, which is the average of the taxes that you're paying in both of those brackets, at 10.7%. So we know that they have tax deferred dollars in an IRA account. It's over $1 million. They're 67 years old, and they're getting ready to have future required minimum distributions start in the next 6 years. So we model their scenario and say, okay, well, what about a Roth conversion? We can add roughly $39,000 to moving that from a tax deferred account to a Roth IRA, and still keep them in the 12% marginal tax bracket. But notice their Social Security taxable income went from $26,400 to $46,750. So if you are looking at the bottom line number down here of 34,600, and you didn't pay attention to more Social Security income, and all you looked at was using the top of the 12% marginal bracket, you could look and say, oh my gosh, we could convert up to $60,000 and stay in that 12% bracket. Well, that's not the case if you're not paying attention to all of these numbers and how they can affect and pull different strings. So for John and Sue, they can do a $39,000 Roth conversion, pay the taxes today, and still effectively stay in the 12% federal tax bracket. This is not including state taxes. They are dependent on the state in which you live. And so it tells us what the cost is. So if we were to do a $39,000 Roth or IRA to Roth IRA conversion, that's going to cost us roughly $7,100 in tax, which gives us an average effective rate of 18.26%. So doing that $39,000 conversion is roughly a $7,100 expense. And so we can model that out and see if it makes sense to do now and into the future. So that's how we look at those. Another question was asked is, can you do those in increments? And the answer to that is absolutely. And that's really based on your unique situation. It's based on your timeline. The more dollars you add, we can change that real quick on the screen and say, okay, instead of a $39,000 conversion, why don't we do a $99,000 conversion and keep our adjusted gross income below the modified adjusted IRMA bracket that we talked about. And this shows what that taxation rate would be. So now we've pushed them into the 22% marginal bracket. Their effective rate is 15.6%, and the cost of that conversion has gone up significantly, but it may make sense in their situation. We want to dive deeper, we can start to look at tax reporting. and really figure out where we're falling inside of these marginal brackets. Tells us how much those Social Security is taxable, tells us what our adjusted gross income is, breaking down into taxable income. And then as Grant was going over, it shows where we're at on those levels for having Medicare premium Part B and D jumps. This is all stuff that we pay attention to. And if your advisor or CPA are not walking you through this, you are not effectively doing tax planning. So just want to state that out there. These are conversations that you really need to pay attention to, and there's proactive things we can do to help that out.
And one question and Aaron, if you could actually pull that back up for me.
Yes, sir.
One question that came just as in the same amount of volume as the question of pros and cons itself was, why consider this? Because folks, when we talk about tax planning, right? A very talented, very good CPA is going to try and have you pay as little income tax as humanly possible today, right? That's their job. And they're very good at it. And I love CPAs. I have a CPA. One thing we forget, though, is future taxation. There are some individuals who will say, well, goodness gracious, I'm Aaron, I'm 67. Why do I need to even consider creating this kind of money? I'm just going to live off of this. My tax rate is not going to go up that much, right? Because look, a $69,000 conversion it could really make that big of an impact on me going forward. And these are the next piece we go into is, Aaron, if you go out of the tax report and back into the situation, make that individual a single filer, right? And what you'll find is this is where, again, peeking around the corners, looking around your tax plan, what are things that could alter or affect this in a negative way, right? Is what happens if we change the entire tax status altogether, remove the conversion, lower Social Security, etc., right? So let's say the taxable pensions, for example, 100% survivorship, those aren't going anywhere. Really, there's no Roth conversion because we're going to take that off the table for just a second. The higher the two Social Security stays, was call it 36,000 for Social Security, right? So go ahead, Aaron, change Social Security to 36,000.
Oh, change it to 36.
Right.
I'm following your lead there, Grant.
Yeah, thank you. I was just going to go into the one question. Now run the tax report. Right. You can see that even with significant income that has been dropped off of the situation, this individual is still in the 22% tax bracket. So this is with significant income decrease because of the loss of a spouse or a filing status change. And the one thing about, just to reiterate what Aaron said about RMDs, every year you get wiser, Uncle Sam is going to take more. And every year the account grows, which is what you want, Uncle Sam will take more. And so you can imagine quickly increasing your income. So we can see here, they're stuck at 22%, right? Now scroll down just a little bit for me, Aaron. Right, they're already stuck in the 22% tax bracket, and that's not a large number. $47,000 of taxable income is not large, but now we're stuck here. And so part of where future planning really is important and why, to Aaron's point, we would really look at situation by situation case, a case by case basis, and really analyze future income needs. An individual with a massive tax deferred account, that's not asking the question, is this really that important? Well, let's ask the remaining spouse how important this is if we continue to exacerbate this problem. So just a little consideration when looking at tax planning, because Aaron did a very good job of walking us through what it looks like today. But something we're peeking around the corner on is always what happens in the future if you're not used to filing a single bracket.
Great point, Grant.
Yeah. So hopefully that was helpful in answering some of the questions that came in through the questionnaire prior to our time together, and also hopefully the questions that were sent in during that conversation. Hopefully that helps answer some of those questions as well. Back to the question that was asked about converting all of your income, I think looking at that example, you can see, hey, if we're converting all of our IRA at once, right? Does it make sense to really rip off that Band-Aid, just pay all the tax today? Think of it as a diminishing return as you get closer to the higher numbers of your tax bracket. Federally, there's a diminishing return on what that looks like. So it really depends on your situation. And then you compound that pain depending on what state you live in. So for very high taxed states and cities, I'm not going to pick on New York City because it's a phenomenal city. I have many family members that live there, but it's just it's a very high tax city. That has to be a very big consideration how we ratchet up income, because now we're not only increasing federal taxation at a high clip, we're increasing state and local and city taxation potentially at a higher clip. Now, if you're living in Texas, well, okay, it's a different story. But for those of us that have to be considerate of those state taxes, that also plays into this discussion as well. And so,
Wanted to
go ahead,
answer
Aaron.
Gail's question real quick
Of
about
course.
the limit on how much can be put into a donor advised fund and how that affects year-end taxes. That's a great question, Kale. Donor advised funds, you can make really kind of two different types of donations. It can be either cash or it could be non-cash assets. A non-cash asset would be my example earlier of, let's say you have highly appreciated stock like NVIDIA or maybe a steel company, something like that, to where you have a lot of capital gains in that. You can pass that to the donor advised fund, but you can only deduct up to 30% of your adjusted gross income. A cash donation, you can actually deduct up to 60% of your adjusted gross income. So that's how it would offset the taxes prior to year end. If you have a high adjusted gross income and you've got some highly appreciated assets or some extra cash sitting there, that donor advised fund has some benefits to it. So great question.
One thing I do want to turn and go back to the conversion piece, because a couple questions that came through were focused on inherited IRAs. And so a question that was repeated was, hey, can we convert an inherited IRA to a Roth IRA? Unfortunately, the answer is no. So once an IRA is inherited, meaning it's gone to a non-eligible beneficiary, for most of us, predominantly it's our spouse, but there are as a very small list of other eligible beneficiaries that will not trigger the IRA to be inherited. But unfortunately, once the IRA is inherited, it can no longer be converted. And that's the rule of the IRS. A small caveat to that is this: if you happen to inherit, though, under the current tax code, and it could change, you inherit a 401k, because of the ERISA designation and IRS designations and differentiation in how ERISA runs plans, you can convert an inherited 401k plan. And there are other considerations we have to make inside of that as well. It's going to have to be very plan specific, again, kind of like the NUA discussion, because a lot of custodians, a lot of plans will run off a very strict plan document. There are some restrictions we have to pay attention to. But generally speaking, the IRS will allow us to do conversions from an inherited 401k to an inherited Roth 401k. We just can't do it in an IRA.
Yeah.
Inherited IRA, sorry.
Great point. And that is actually one of the questions that's on our slides, I believe, is can you do in-plan conversions from like a 403B or a 457 plan? So we might as well just start that
There we
conversation
go.
right now. So Grant, in your past career, I mean, in your career as a financial advisor, you did a lot of work inside of 403B plans, 457 plans. You spend a lot of time in the 401k industry, so you're better equipped to answer this question than I am. So I'll pass that to you, sir.
No, I appreciate that. Well, I've had my past life in the retirement plan space was very fruitful and educational, and I'm grateful for that time there. To answer this question succinctly and simply, the answer is yes. As long as the plan document allows for Roth dollars. It's still interesting to me today how many plans still do not have Roth IRA, or I'm sorry, Roth IRA, Roth capability. But I will tell you, with the Secure Act changes that took place in our recent past, by 2026, by the end of them, a lot of plans, the goal is to have the vast majority of plans have Roth capability. Once that Roth capability is present, then I can absolutely do in-plan conversions. I will just lay this out there, be mindful of what the custodian who's managing that 401k will consider when making that conversion. Here's what I mean. When doing a Roth conversion, what we've not touched on is that ideally, if you can, you want to convert all the dollars, every penny from the IRA to the Roth IRA, meaning you would, if you can, you don't want to have those dollars withheld from the conversion to pay for tax purposes. Why? Because it means less dollars get to be invested into the Roth, and it just takes that much longer for the Roth IRA to be invested. Now, there are very good reasons why you'd want to do that, but generally speaking, you want to try and pay for that tax obligation. Sometimes in 401k plans, they will require you, it's a mandate for whatever reason in some plan documents, that you withhold a mandatory 20% federal tax withholding. So with that being said, you want to be very clear before you do an in-plan conversion, what the tax obligation, what the tax responsibility is going to be, and are they going to force you to over withhold or withhold it all in the plan? And so again, it's a case-by-case basis, which is unfortunate, because just remember that the government sets the overarching rule, and the custodians or the entities that manage our money, they can have a far stricter approach if necessary to protect their liability. So just another consideration. Easy answer, yes. The last strict, just make sure you're aware of some of those rules.
Two quick things to talk about there. Just as a reminder, one of the pros and cons of the Roth conversions that I forgot to mention is when you do a conversion, there is a 5-year rule. So there's a 5-year clock on when you could access the gains from the conversion. So you always have access to your basis, which is the conversion amount. The second thing on in-plan conversions, and I'm not going to go deep into this conversation. If you have questions, please reach out to Grant or myself. There are things called special recapture rules. So if you're under age 59 and a half and you do an in-plan conversion and then later take money out of the Roth IRA that you converted or rolled it over to, there could be some recapture rule where you'd be subject to a 10% penalty. So if you're thinking about doing in-plan conversions, it's wise to reach out to an advisor that is very, very knowledgeable in those types of things. So just a caveat to that.
And then Jubilee, let's go ahead and go to the next slide as well, because I love these topics, but I'm recognizing we're running out of time very quickly and want to get to as many of them as I can, and make sure Aaron and I have the time to do so. So self-employment, retirement strategies, and options, Roth options. Woohoo! I wish we had another hour and a half. So for those individuals and families that own and run businesses, you're self-employed and you're really filing, you haven't incorporated, you're using that Schedule C, or you have Schedule F farm income, for example. My goodness, there's so much you can do. The tax code really opens up to you as far as the options. And Jubilee, let's go back to that one more time because I got so excited I forgot the question. Sorry, guys. I'm like Tommy Boy in that movie. She gets so excited, I break open the bread roll here. Here we go. Strategies and options, Roth options. Absolutely. This self-employment allows us to really control and maximize retirement plans. Thank you, Jubilee. We can take that down now. And what I mean by that is this. So going back to those 401k plans, just to put it quickly, you have 415 limits. And so disregard the numbers I'm using. They're going to be immaterial to you. What that means is we have limits that the employee can put in and limits we have the employer can put in. And so when it comes to a retirement plan for those that are self-employed, depending on the amount of income and cash flow that's circulating through the business, Schedule C or sole proprietor, I'm sorry, or S corp, right, or partnership, you can really structure how much income we can take off the 1040 and grow tax free by using cool tools like individual or solo 401ks. Here's what I mean. For an individual, the 415 limit, that combined number of employee and employer, is substantial. So if on one hand, we're protecting tax liability, we need to defer a lot of resource, the business can put in an employer contribution to a very significant number inside of the solo individual 401k for tax deferral. But if we're also doing tax planning, they can make a Roth contribution on the employee deferral and get the best of both worlds. And then there's other elements that come into play with after-tax dollars. We can do even mega Roth strategies, which get really wild and fun. And so I guess maybe you probably hear change in my tune and excitement, because this is the stuff that Aaron and I really love to get into, is we're playing these very detailed chess games with Uncle Sam. But when it comes to self-employment plans, having that individual 401k or other tools, deferred compensation plans, etc., really open up a lot of cool planning metrics, especially if we are running into a situation where either we're looking to defer income or we're trying to build tax diversification along the way. Lots of fun stuff there. And if you're in that situation where you're running a business, or you're self-employed and filing that, sole proprietor tax return, Schedule C, Schedule F, please, please, please schedule time with us to talk about your situation, because there's a lot of cool things that we can engage in very quickly, even before year end, to make your situation and your tax liability far better in the future. Jubilee, we'll go to the next slide as well. So how to determine the amount of taxable income for the current year. Sorry, I gotta move my pictures of all of you over. So how to determine the amount of taxable income for the current year to date in taxable Schwab accounts. Aaron, I'll let you take that one, my friend, and I'll back you up on it.
That's very specific. If you do have Schwab investment accounts, it takes a little bit of digging into the Schwab's online platform. The best way that I, tell people where you're looking to gather that type of information is specifically from one type of account, actually two, but if you're doing IRA distributions, you're going to get a 1099-R at the end of the year. That will tell you how much has come out of your IRAs. Where this question may have stemmed from is a brokerage account, so an investment account that you're getting dividends, interest, capital gains, those types of things. The Charles Schwab statement shows your dividends and interest accumulated for the year. So if you look at your current monthly statement, it will have a year-to-date column that will show you what your dividends and interest are for the year. The second thing you would want to realize is, what are my short-term capital gains and long-term capital gains? Inside of the Schwab online portal, there's a capital gains or a cost basis tracker, and you can look at what has been realized for the year versus unrealized. Realized gains means those positions were sold, and short-term is a less than 1 year period of time. Long-term is greater than 1 year period of time. Those two are taxed differently. Short-term capital gains are taxed at ordinary income rates, so those marginal brackets that we talked about, and long-term capital gains are taxed favorably at a 15% rate. 0 if you're in the 12% federal tax bracket or below, could be as high as 23.8% if your income is over a certain amount. So in the Schwab app or the Schwab online center, I would look at the year-to-date statement, because it will tell you your dividends and interest, and then there's a cost basis tracker that will show you what has been realized for your capital gains for that year, and that kind of gives you a broad idea of the income that's being derived.
Question. Jubilee, we'll go to the next slide real quick. Oh my gosh, I want to rewind the clock. So additional questions. If it's okay with everyone, I'm going to go ahead and pull a few that I would love to spend a little bit of nuanced time in. One that came through related, going back to the businesses. So business entities, What are some strategies that S corps and LLCs can deploy for tax savings? Having a business, running a farm really offers a lot of tax leverage. And working with a good CPA on this is critically important. That's what I wanted to bring us back to, was coordinating tax planning with a CPA is critical. And having a team that you can rely on to help facilitate that conversation is also critical. Here's why. Just to give what's going on in the CPA world today is, for the first time in history, and Aaron, refresh me, I think it was this year or last year, we had the fewest graduating. Last year, thank you. We had the fewest graduating, well, you could say,
graduating class of
tax accountants.
Yep.
Meaning that there's not a lot of individuals trying to enter the industry to be CPAs on a tax preparation basis. A lot of individuals want to go into corporate taxes where they think all the fun is. Well, here's the downside to that. The downside to that is there's not a lot of individuals entering the industry who are going to be here for a while, who understand how to do a lot of the planning that Aaron and I are discussing, who are going to be able to help facilitate the conversation on LLCs and S corps. So aligning a team, building a team that is knowledgeable and has your best interest at heart is just as important as the tax planning itself. And so if you find a good CPA who does good tax planning, who has the margin to do the work and is willing to coordinate and collaborate with your other team members, like a financial advisor, financial planner, etc., that is worth its weight in gold. Because again, I could spend the next hour and a half talking through just strategies for sole props, let alone S corps. And there's just a lot of good ways to address that. Another thing, again, going into the, sorry, I'm trying to multitask. You guys are seeing very clearly I don't do a very good job of it. When it comes to those entities as well, in tax savings and those corporate plans, there's also things that we can naturally do, and this is where CPA becomes very important. As far as real estate purchase, real estate repayment to the business, having, control groups, having children and grandchildren enter the business as 1099 employees. There's all kinds of cool things that we can do and really get into the nuances of the tax code. So again, if that's your situation, one more time, please set up a meeting with us. We'd love to have the conversation with you.
Grant, Joe put in a question. Do you have planning tips for clients who are only high income W-2 and are looking to reduce their taxable income? Joe, to answer that, yes, but it may take an individual conversation to at least think through that. Depending on your overall situation, what your income level is, maybe diversifying away from the actual stock market into real estate investments to where you can depreciate some income, or have investments that allow you depreciation on your tax return, may be a huge benefit in that factor. So there's other strategies that we can employ, but the basic things to reduce high income W-2 is making sure you're fully maxing out your 401k contributions. If you're high income, you're likely not eligible for IRA deductions for traditional IRA contributions, making sure you're maxing out your HSA, all of those types of things we would have conversations on. But what could we do from a tax return standpoint that's actually adding maybe some depreciation or business income in there that we can potentially take some losses on?
And also too, and Joe, to answer the question with another perspective, this is harder to plan around. Being a high income W-2 wage earner has its pros, but one of the cons is this: it is very hard to maximize as much deferral as humanly possible if the company you work for, if you don't own it, if they don't have other planning tools like deferred compensation. One thing we've had highly compensated team members or families that we care for, individuals we care for, we've had them go to their employer and say, would you consider a deferred comp plan that maybe we can deploy, and we've helped those companies set those up.
Yep.
So other things that we can engage in, but it's very hard as a W-2 employee. One thing I'll have you think through as far as tax planning for your future, because yes, I respect completely where you're coming from to reduce that liability today. But something you want to talk about for your future is let's not stack all of your chips in tax deferral and consider other ways to build up tax diversification, because what I would hate for to happen for Joe, for you, if um, you're employed and then you stack all this tax deferred money away. The other problem is then we get to where you're cashing in or turning in your keys and enjoying your life after work, which is retirement. And all of a sudden you're in a worse tax bracket or tax position because the tax codes changed along your working years.
Yeah.
Um,
So
and
he's
so,
employed
yes,
a lot of
thank
the
you.
strategies there, Grant.
Yeah.
Thank you, Joe,
So
for sharing that.
yes, absolutely. So yes, you're doing a lot of the good strategies already. So some things we can do to really kind of move forward with you. Ooh, good. Yeah, good question. So what is the mega Roth, and do I need employer support? The mega Roth is essentially if the corporate tax plans, the second part of the question, yes, you'll have to talk to your employer about that. If the employer in their plan document allows you to make after tax contributions to the retirement plan, so not Roth, contributions, not tax deferred contributions. They allow you to make after tax contributions. You can essentially pay additional income tax, put in up to the limit, and then convert that money. And I use air quotes because it's not taxable. And sorry for my little pen here. For those who saw it, it's got a little white ball on it. The ones on the desk. The air quotes signify that because you've already paid income tax on it, you have to pay income tax on it again. And you can stack additional employee contributions into the retirement plan.
Up to
So
the
it's cool.
415 limit that you mentioned earlier.
Up to the 415 limit, Aaron's correct. So really cool strategy, but needs employer support there. And yes, to the additional question to that, there will have to be document changes in the plan to allow that. And that does come at the cost of the employer as well. So it will depend on the advisor leading your plan sponsor, aka your employer, to see if that makes sense in the plan, because you're also going to have to factor in testing rules and all kinds of other considerations to the plan that could make it harder for the plan to operate. So just something to keep in mind. Absolutely.
One caveat, Grant, or one kind of last minute tax planning strategy that I thought of as we're ending our time is if you are a high income earner and don't have any outside IRA accounts, all of your money's inside of a 401k plan or an employer sponsored plan, talk to us about a backdoor Roth IRA. There's ways to where we can still get money into Roth IRA accounts through what's called a backdoor contribution. And that's where you're making a contribution to a non-deductible IRA account because your income's too high, you can't deduct it on your tax return. And then we can move and immediately convert that to a Roth IRA. So there's strategies for high income earners to still get money into Roth IRAs outside of employer plans, as long as you do not have IRA dollars that are outside of a plan, because you could be subject to a pro rata rule. And that is a topic for another hour-long discussion, and we're not going to get there. So just wrapping things up, we'll go to more questions. But things to consider before year end: if you're making any charitable gifts, those have to be done prior to the end of the year. If you're 70 and a half, think about doing QCDs to be able to gift to charities. Any sort of donations need to be done prior to year end. Make sure you're max funding your 529 plans if that gives you a tax credit in the state that you live in. And also make sure that you're funding HSA accounts as well. So Grant, I'll turn it back to you.
Yeah, and then so last thing for those for questions we didn't get answered, or if it makes sense for your situation to engage in a complimentary next steps meeting, we do mean complimentary. You're not writing us a check. We want to provide value to those that we engage with, and we also don't work with everybody, right? Sometimes we're not a good fit for everyone, but we still want some. If you're going to spend time with us, we want you to walk away with things you can do today, things you should consider tomorrow. And if we do work together, you'll have that written plan we work off of going forward. So schedule a meeting with us and our team. There's a 800 number to set up. Send us questions afterwards to talk to FEG@lifeafterwork.com and scan that QR code. And just a last little tidbit for the question that came in last about Social Security not being taxed, and does that mean we can or we should consider doing Roth conversions later? One thing I'll leave everyone with is this: tax planning is not something you set and forget. Tax planning has to be adjusted for tax code changes along the way. Aaron and I affectionately call that job security. So depending on how the tax code could change, we'll make modifications as well. But you always want to plan on the code that is in existence, right? Not the code that could be speculated. You don't want to get yourself in trouble. So thank you all for everyone's time. Thank you for being with us today. It's been such a pleasure. Really appreciate all of your questions. These are wonderful. I apologize we couldn't get to every one of them with a time limit, but just know this: we will be doing these again in the future. There will be other team members that will be joining us who have expertise in certain areas as well to engage in these. So we hope that this was valuable. We look forward to seeing you again next time. And for those that have direct questions, we look forward to seeing you soon. Have a great day, my friends. Take care. God bless.